Hello, and welcome to the Wade Borth Podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Welcome back to the Wade Borth Podcast. Today, I have a super special guest with me today, a good friend of mine, a gentleman I've known for a lot of years, Barry Dyke. And Barry, you and I have known each other a lot of years. I was trying to think of the first time we met. Was it in 2007, maybe, down in Florida?
Yeah, I think Orlando, whatever. Yeah, one of the Circle of Wealth things. I think back then, or around then, about that time, I think.
Yeah.
So, it's good. Yeah, you're a good guy, Wave. It's 15, 16 years now. I don't know. The time flies by, doesn't it?
Yes, it does. Yes, it does. And it's, some of the things that we'll talk about today is, time does fly, but some things from your original book, which was researched in, I think, 2005, 6, and 7, which predicted kind of the 08 crash, 09 debacle. Even though it's been a long time ago, some of those things just haven't changed. The same thoughts are happening, reoccurring over and over again. So it'll be fun to get into that with you as well. I've appreciated, so for the listeners that haven't read Barry Dyke's The Pirates of Manhattan, this is probably one of the foundational books that changed my thought process, along with Nelson Nash's Becoming Your Own Banker, Creatures from Jekyll Island, and a good friend of mine, Dwayne Burnell's books. This is one of the books that changed my thought process. And so I thank you, Barry, for writing the book. I thank you for introducing me to it, because it just really put a whole different perspective around how we think and how we address stuff compared to what we're being told in their actions. And what I mean by that is, I look at, and one of the big things we'll talk about with the Pirates of Manhattan, and again, you had Pirates of Manhattan 2, and then Pirates of Manhattan 3, which I have to say I didn't read that. And then
that's the last one. Yeah, that's gonna be the last one. So I did the Pirates of Manhattan 1 and 2, and then and actually, I was going to update Guaranteed Income, but it's actually going to be the Pirates of Manhattan 3, because it addresses things like cryptos and stock buybacks and SPACs and all those other crazy shenanigans, which are really polluting the whole economy, if you will.
Yeah. So just a plug. So if people want to get your book, I'm sure that you have access to. It's on your website. Would you want to just throw that out there for the listeners?
Yeah. People just go to barrymajamesdyke.com. That's the best way to do it. I don't sell them on Amazon. Maybe I will in the future, but barrymajamesdyke.com. And actually, people, it is for sale on Amazon, but people are selling copies of my book for like $100 each. But if you go on the website, you get it for about $30. So just go to barrymajamesdyke.com.
I would say it's well worth the $100, even if they spend that. They don't have to.
People do spend, but it's crazy, Wade. But they do. So it's so sometimes they bulk sell them, buy them from me, and I don't know what they do, but anyway, so it's great to see you, and great to see you pushing back the frontiers of ignorance, and wherever you want to start, Wade, is I'm your guest.
Well, I appreciate that. So, and again, but like I was telling you earlier, just before we started recording, I hadn't read Pirates of Manhattan for a while, and it was one of those things that I picked up the book, and there was so much good information in there, and one of the things. I think the last time that we actually met in person was a couple of years back, and you actually came out to Bismarck, North Dakota.
That's right, I spoke.
A good friend of mine, Mary Jo Ehrman, had an event. You spoke at that event, and one of the things you talked about, and which is really kind of interesting because so much is developed in this space, is the idea of pensions. Now, not a lot of people have pensions anymore, but there are pensions. Nobody has them except for government employees, right?
You got it, essentially, yeah.
And if you are lucky enough to have a pension, you want to make sure that it's safe and secure. And so maybe talk a little bit about the underfunded of pensions and how, when you bring that up, talk about how this idea of guaranteed income with your book, Guaranteed Income, kind of comes into play, if you wouldn't mind.
Well, yeah. Well, the fact of the matter is you're correct. I mean, the only people who have, corporations that have pensions are people like, I don't know if Caterpillar has them or people, the large industrial companies. A lot of them have been terminated, such as General Motors and what have you. and they have to and to just stop funding them. Now, what my research reveals, and I'll get into this in the latest book, will be how really using a life insurance company to purchase an annuity to de-risk and take and to solve the problem. And General Motors was the first major company that bought $29 billion worth of annuities back in 2012 to take care of their pension plans. And last fall, in September, IBM, a little company called IBM, just a little company, they bought $16 billion worth of annuities to fund their pension plan for 1,000 participants and their beneficiaries. So the whole idea is that even corporations saying, "Hey, we can't manage this. Let's turn this obligation of ours over to an insurance company because they know how to really know what they're doing in this stuff." So it's very, very true, and really for individuals, it's really most people can't manage the market. It's just impossible. But they do need income and guaranteed income streams, and really the best thing is to see an advisor like you use the various annuity products out there. And I tell people to stay with mutual companies because they're the best. But this is what we're seeing now, and the problem with the government pension plans, they are the best. That is correct. But the problem is government pension plans are exempt from ERISA, Wade. In other words, if I'm running a pension for IBM,
I'm shocked.
Yeah, so they're exempt from ERISA, which is essentially the whole body of law which governs corporate pension plans. However, but if you're a government employee, those rules do not apply. So I don't know how it is in North Dakota, but a lot of states, this is really well known, such as Illinois and Kentucky and New Jersey and so many states. They're virtually melting down. So, but the thing is, one of the safest places to warehouse your capital is with a life insurance company, and so that is new. This is something which I will be revealing in the next book.
You mean these low down, dirty life insurance companies that are just ripping off all the consumers? I mean, those companies that these big corporations are now relying on because they couldn't manage their own money.
Yeah. That's the irony of the whole thing. So actually, conservative is a good thing. As Will Rogers said about 100 years ago or 90 years ago, he said, "I'm more concerned about the return of my money than the return on my money." And I think people need to do this. Hey, wait, let's look at 2002. The S&P 500 was down 19%. Okay. You're going to need a 20% return just to get back. You're going to need like almost a 40% return just to get back even. I mean, the NASDAQ, which is, the tech-heavy section of the economy, that's down 33%. The Dow is down 9%. I mean, it was a bloodbath. It was the worst year since 2008. And the fact of the matter is the I don't know if you remember the dot-com meltdown, Wade, but I think this is what we're seeing now is worse than the dot-com meltdown. Matter of fact, I'm positive it is. So again, people being safe and prudent is really, really a smart thing to do. And but theory which I've developed is that you ever heard of what is called the Stockholm syndrome, Wade? Okay.
Yes.
Okay, that's when these bank robbers, I think in Sweden, like in 1973, they robbed a bank and they took hostages from the bank heist, and the Stockholm syndrome essentially is, and when the hostages were finally released, they sided with their captors, and which is kind of goofy. Okay, and my point is that this is what we're seeing with a lot of these 401ks and TSAs and IRAs. Even though people are getting hammered in the market, they're siding with their captors, which I call the asset management industrial complex or the Pirates of Manhattan. So it's really kind of weird, but I've seen it. I see it in my office even to this day. You see it where people will they'll come into my office, they'll have $300,000, $400,000, $500,000, and they've just lost $100,000, and they're saying, "I think it's going to come back." Yeah, I think it's going to come back. And I was like, "Really?" I said, "Well, you ever heard of Japan?" And people say, "No, what happened there?" I said, "Well, the Nikkei 225 was essentially the S&P 500 index in Japan. In 1989, it hit its peak weight in roughly around 36,000, 38,000. So it hit its peak in 1989. Then it crashed, okay? And it went to a low around 7,200 or something like that in 2009 when we had that last correction here. Now, back when in 2012, when all this money printing went up, the Japanese markets went back up. But At the end of last year, the Nikkei 225 closed around 26,000. So after 33 years, the market in Japan never came back.
33 years of lost opportunity with your money.
Yeah. So this is the whole thing. People say, "Well, I think it's going to go back up." Well, guess what? No, folks, don't take my word for it. Google it. Okay, look at the Nikkei 225. Look at the track record between 1989 and 2022. There was 33 years of loss, 3 decades of losses in the stock market.
That's interesting because, just in retirement planning, when I'm working with people, and again, going back to, Nelson's book and the idea of retirement doesn't really come into play in his conversation.
No.
But we retool. I like to call it, we might want to retool in our lives sometime. And when we retool, the idea is like, well, I'd like to have some passive income. But the problem you have, especially with like 401ks, it forces the individual to do something that professional money managers at institutional levels can't do. And that's guarantee that you have money for as long as you live. And that variable changes for every person. And so it's this big unknown. And so it forces you to try and manage it to the point where I have clients that are so stressed out because they have assets. And I think it was Tom Hegna always says that people with income streams are happy and people with assets are miserable in retirement.
Yeah, Tom, I know Tom. So, and I was actually I don't know if did you see the new documentary movie I'm in, The Baby Boomer Dilemma?
No, I have not seen that or heard that.
Go to there's a link on the web, boomermovie.com. I'm in it with Tom Hegna and and two of the top economists in the country, William Sharp and Robert Merton, who got the Nobel Prize in Economics. Who's in it? Ted Siddell, my friend David Walker, Ted Bennett, the guy who created the 401k. It's about using annuities and things like that for retirement plans. And so, yeah, and Tom Hegna's in it. Tom is a fantastic speaker. He really is. He's very, very, I don't know if he's good at Italian and whatever, but he's just really good at presenting stuff. And but no, he's spot on. And the whole thing, the purpose of retirement plan, Wade, is to produce retirement income. Period. End of story. I don't care who we talk to. That's the most important thing. But Wall Street and the Pirates of Manhattan have turned it into one big casino. And that's and unfortunately, Wade, it's actually gotten worse than it was in 2008 when 2007 when I wrote the first book. So it's actually we're kind of continuing into the Wall Street casino.
And that's the first part of your book, the Pirates of Manhattan, right? So it's the casino age, right? That's it's so funny you bring that up, but you're right. In retirement planning, our number one issue is to provide a safe, secure, passive income.
That's it,
right? And guaranteed, and nowhere else, nobody else, even the big corporations in this world are understanding that the only people that are good at that are people that are good at knowing when the groups of people die, and they can give you a guaranteed income. That's these big, the largest institutions in this country, in this world, are life insurance companies, right?
Well, yeah. The thing is that life insurance used to be really big, but what has happened, Wade, is that in life insurance they have to look at their portfolio. They're generally happy to get a 5, 6, 7, 8% rate of return, year in, year out on assets, which I think is fair and conservative, and I think it's really a good objective. Whereas Wall Street wants everything to be 15% year in, year out return on equity. It ain't going to happen. It doesn't happen, okay? And so it's highly unrealistic. So what you're seeing is that these giant asset managers like BlackRock, who is the largest asset manager in the world, largely due to you and I and the taxpayer, they had 10 trillion in assets, but even with all the money they managed, they lost like 1.7 to 2 trillion in 2022, Wade.
Yeah.
So these are the facts. So what has happened with the Secure Act? Annuities are part of the retirement plans now, but there really has been implementation on that really very much. Wade, I'll give you the statistics. There's very, very low penetration of annuities into the retirement space, but so it's very interesting and actually but if you look at some of the best retirement systems in the world, and this is what I did do, I looked not just at the U.S., but I looked at who are the best retirement systems. Do you know where the United States ranked, Wade, in world rankings? In terms of the top 20 industrialized countries in the world. What do you think the U.S. stood in the top 20, Wade?
For what?
having the best retirement plan.
for retirement benefits, or
being the best retirement plan, and number 20 being like the worst.
okay, so the top 20 countries, industrialized countries, you're asking the question of how do we rank?
Yeah.
In regards to what? Retirement age?
In terms of where do you think the United States, on the top 20 industrialized countries, who has the best retirement plans? Where do you think the U.S. are they number 1 and number 20, or somewhere in between? What do you think?
I would guess we're closer to 20 than to 1.
Yeah, yeah. We rank around number 19, so we're actually, in terms of financial security, we're right next to, I think, Chile or one of those countries. I mean, we're kind of really pikers in terms of the best retirement systems are really, in Iceland and Netherlands and other countries. We're actually our retirement systems are horrible.
So why is that?
Well, because a lot of it is they're not planning for retirement. It's really about gambling and speculation. Okay, whereas for some places like the Netherlands, Wade, where they actually have the defined contribution plans like we have, which are 401ks and 403bs. You're actually required to use an annuity, and you're not allowed to take a lump sum. So when it comes to having the sound retirement, they require you take a annuity for your retirement plan. So which makes all.
And just for the listener, an annuity is a product that only life insurance companies can offer, and it's I think the term annuity means income for life. Right?
Yeah.
The people that don't understand what that is.
Yeah, it goes back to the Latin annua, which means income for life, which goes back to annuity's been around since time of Rome when they gave Roman soldiers pensions after fighting for Rome. So that's where the word. So they've been around for thousands of years.
Yeah, it is crazy how that the industry that we're in and the industry that we have made our living on and have contributed to for all these years has got such a bad rap. And again, I think part of that is about control of money. They saw all this money flowing. I read the manuscript from the Senate testimony regarding MEC calculations on life insurance policies. Have you ever read that? Have you ever seen that?
Yeah, that's like the 100-page thing. Yeah.
Yeah, and it's boring as all get out. But the interesting part was like who was testifying why they should stop money flowing to life insurance companies, right? And so it was the head of J.P. Morgan, it was the head of Chase, it was the head of a guy by the name of Al Williams, who all these people that wanted access to those dollars that were flowing to life insurance companies. And I just like, the testimony itself wasn't that impressive, but just the fact that look who was testifying against it and who was testifying for it. They didn't bring anybody in to testify why insurance companies should continue to have that much money flow to insurance companies.
Yeah, so that's the whole thing. No, but if you just look from a structural perspective, then a life company obviously stronger than a bank or an asset manager, and because they actually, as Nelson Nash impressed on me, everything they issue is a contract. It's a legal contract. It says we promise to pay. In asset management, the only thing it's promised to pay is the asset manager that guaranteed promised to pay their fees. That's it. Okay, and if people really read their brokerage statements, or if they read their arbitration statements attached to the brokerage statements, people would probably never, they'd probably never invest because essentially it's all lawyer to the heavens, Wade, and so there is no protection. But with a life insurance contract or annuity contract, it is a contract. So any lawyers out there know the value of a contract. So that's really one of the pure beauties of a life product.
And I think back, and again, after reading that, and it's been a long time since I've read that testimony, but it is about how do we control people's money. And you get, they hire and they get people like Dave Ramsey and all these financial entertainers. I don't call them, they're just entertainers. And they get people to think in a conditioned way. We talked about, The Madness of the Crowds by Douglas Murray. And it's just this thought process that people go through. And you get people to think like the crowd, and then they're shocked when they get the results that the crowd gets. And to your point, if we're like the worst retirement worst country when it comes to ranking of retirement, why should we be shocked by that when we've been conditioned to think, like the crowd? We have to kind of break that mold a little bit and think a little bit differently and say, how is this in my best interest versus how is this in the best interest that Dave Ramsey or Prime America or somebody's trying to tell me that buy term invest a difference, when that obviously has not worked.
It doesn't work. It never will work. And the thing is that because no one knows for the future. We don't know what's going to happen next week. Never mind. I don't know what happened for dinner tonight. Never mind what's going to happen next week or next year. So it's just a guess at best, an educated guess. But whereas with life contract, I mean, there's some mathematical and actuarial calculations which are very sound than what we're given from Wall Street. And so 2022 was a bloodbath, and people are licking their wounds, and and we manage money here too. And I'm not against investments; we do manage money, but we're very prudent with it. And I think the more I understand it, the more I realize it's really, we have to be good stewards. We have to be real. When we're talking people's hard-earned money or in their savings way, the first thing should be preservation of capital. And if people don't believe me, they should look at something like you ever heard of a guy by the name of Benjamin Graham? He was the apostle for everyone loves Warren Buffett, and Graham said the first thing, most important thing about any investment is preservation of principal in return of your money. Okay, so here's kind of
wasn't that rule number one is never lose capital?
Yeah.
Rule number two was refer back to rule number one. Is that?
Yeah. So that was Benjamin Graham, who's Warren Buffett's kind of idol, and so when you look at really sane people, this is the thing. But we're America is a crazy country, and so we believe that we can get something for nothing. And Wade, I've been doing this for a long, long time. I know you've been doing it a long time, and you and I are much better doing what we do because we're doing it for a long period of time. And so, but it takes years of training and seasoning and hard work and all this other kind of stuff. And we know that in anything, whether you're a doctor or a carpenter or whatever the case may be, or a teacher, you get better. But when it comes to retirement planning, we're saying, throw it in the market and we'll make money. Well, guess what? It's not happening. And then when we had all this printing of free money, it's been a heck of a party, and now it's going to be a very big hangover,
Well, and it's interesting, so I have a couple points there. What the point I try to make with people about life insurance, especially a whole life insurance, properly structured whole life insurance, if we think about it from a very high level, from the very rudimentary level, I should say, what is a life insurance? It's a contract to begin with, right? So to your point, it's a contract. Mutual funds don't offer contracts to you. But more importantly, it's a contract that in essence, a professionally managed bond and real estate portfolio done at this institutional level for your benefit and a guaranteed never to go backwards. I mean, how powerful is that?
It works, but it's boring. But what put me on the map, Wade, is that I was the guy who said, "Oh, by the way, this is how much J.P. Morgan has in life insurance, or Bank of America, or Citigroup, or and all these." And the irony of the whole thing, I don't remember in the first book I did that thing about Citigroup, because at the time Citigroup owned A.O. Williams, which is now Primerica, and they've been spun off again. And then I posted it because A.O. Williams made their money, or Primerica made their money by telling people to buy term and invest the difference. And then when A.O. Williams sold his company to Citigroup, right after the Citigroup purchased Primerica, they bought like $5 billion of permanent life insurance for their own account. So I put up this is 10, 12 years ago, I put up the video on it. So I made the argument that essentially A.O. Williams owned a lot of high cash value life insurance companies. He sold his company for $1 billion to Citigroup. So the hypocrisy is just incredible. And then what will be interesting, you'll see in the new book, Wade, is that people say to me, Wade, well, I've never heard any of this in the media. No one ever talks about this stuff. In the next book, Wade, I disclose or unveil, if you will, how the major media companies like the BBC or CBS News or the New York Times or Gannett newspapers or the Washington Post. They're all buying huge annuities for their own retirement plans, and then what I also add in is that how major institutions are using buying annuities and life insurance as well. And as you know from the first book, but then I go actually document how Bank of America, Merrill Lynch bought a $500 million annuity to fund their pension plan in England. So it's total hypocrisy. You couldn't make this stuff up. But I've documented everything from 10Q filings from the SEC. So it's public data. I'm just a good researcher.
Yeah, to the listeners, and this is the thing that I've always appreciated about you, Barry, is that you are a ferocious researcher. I've never seen anybody research a subject as much. And when you read Pirates of Manhattan, and I would encourage everybody to go read Pirates of Manhattan, even though, it was published, what do we figure, 14, 15 years ago?
Yeah, I still sell it. They still sell a lot of it today, yeah.
The research that's done into the documentation in the footnotes and just all the research, you are the research king. I have yet to see a person that can research a product or research a subject as well as you do. So thank you so much for your hard work, because that's not my forte. So thank you for that. But I've often said that, as I get older, and you'll appreciate this, we see better than we hear. And so, like banks, for example, Bank of America today, they tell you to do one thing, so they want you to hear something. But if you look at what they're doing, $25 billion in, what we call bank-owned life insurance or whole life insurance is what it is, right?
Yeah.
And so they're putting their money there, but they're telling you to do something different, just like you've documented back in Pirates of Manhattan. You go back to even 2002, what was happening there. It's so funny and interesting because they tell you to do something and then they go do something else. So why shouldn't we just emulate what the banks are doing? I'm not a big fan of the banks, but they make money.
Yeah,
they speculate a lot, and we have to bail them out. But we bail them out because they make poor decisions. But some of the things they do are very sound decisions, right? And so we should emulate some of those things that they do. When they use money, they charge interest for it. We should do the same thing.
Yeah, I mean, when you can create money out of thin air, it's a great business to be in, And yeah, but they've all turned into asset managers, and the fact of the matter is that they're not really that good at that asset management, and actually for their own account, this is the iron in the hole. Although they charge a lot of money gambling other people's money, regulators will not let them put their reserves into equities because they're so volatile. Yeah. So this is the whole thing. So they make all their money, like Morgan Stanley, whatever, makes 70-80% of their money gambling and wealth management and mergers and acquisitions and stuff like that. But you know how much Morgan Stanley has of their own retirement, of their own pension plan in the market? Wait,
zero, probably
zero,
double zero.
Yeah, and it could make this up. Okay, their own pension plan has about $3 billion. It covers about 27,000 employees. They have zero. So here's Morgan Stanley makes all their money in gambling with other people's money, and they call it proprietary trading, which is actually gambling. Actually, have zero money of their own pension plan in equities. It's all 100% investment grade bonds.
Yeah, and it's interesting. Just like I said, as you get older, your eyes work better than your ears. So just watch what those banks are doing with their money. To that point, again, when they're using somebody else's money, it's easy to put it in the market and risk it because it's not your money. You had in the Pirates of Manhattan, you had 8 reasons why banks are bully, right? Bank-owned life insurance. What are some of the key factors of that? And you had 8 reasons. And I, we won't go through that all today, but there are some key benefits to doing those type of things. And this, I want to just touch on this a little bit. Is that it's they can borrow against it. I mean, reasons why banks love to put money into whole life insurance. It's guaranteed. And they can go into Pirates of Manhattan and read the 8 reasons, and maybe you can just run a quick synopsis. But it's guaranteed. Or 1, it's guaranteed. 2, they can borrow against it. 3, the money goes up every year. It doesn't have to go up a bunch because to make up for a loss from the previous year. And those to me are the biggest things where that's why I encourage people and have a conversation. It's like, where are we putting our safe, secure money so we can go out and buy real estate, so we can go out and buy these other things? Again, I'm like you. I'm not opposed to putting money in the market, but don't have that be your safe, secure capital, because it's not.
It's not, and this is the whole thing, and it's actually gotten much worse. And and the thing is with these banks that are publicly traded, way people don't realize it, but actually as the increase with the guarantee increase with the dividends on the policies each year on the policy and Tier 1 capital, and people go to barrymamesdyke.com, buy the book, but in any event, it actually passes through to them through their income statement. And it will actually give them 3-4 cents a share, earnings per share, which is, to you and I, it's really nothing, but it's a big deal for Wall Street. So as the cash value increases on the balance sheet, it also is a pass through to their earnings statement. So they love it. It's an economic workhorse, and but this is thanks to guys like you, we can get this information out there, because even to this day, as I say, the press will not acknowledge the research which you and I have done.
I'm gonna quote you in your book here again. It says, I love this phrase. He says, permanent life insurance is a green oasis in the scorched earth world of finance.
That's pretty. I wrote that.
Well, it's in your book. I don't know if you wrote it,
but
it's in your book.
But it is. It actually that's not. I should put that. I forgot all about that, but that is. And when you think about it, I mean, when you think of all the craziness going on with the stock buybacks and the cryptocurrencies and the SPACs and the debt funded dividends and all this stuff, you look at life insurance, it looks pretty darn good. That sounds good. I like that. Yeah.
Yeah. Well, again, I was just reading through the book this weekend. I'm like, oh my gosh, it was just a great line, and I'm going to start using that. So I'm going to borrow it from you, and I'll give you credit.
Please do.
But it's interesting because I have a lot of real estate investors that use their policies, and what they're really starting to realize is the same thing that these banks, right? So they have this growth of their capital grows each and every year, no matter what happens. And so that asset, which is their life insurance, and they've borrowed against it, and they put they paid it back again. They haven't consumed it. They've borrowed against it like any other good asset, but it goes up each and every month, each and every year. I mean, it increases without fail, unless I, as the policyholder, do something to stop that.
Look at all these stocks, like all the FANG stocks. Remember, I don't know if how it is in North Dakota. Remember, everyone said you got to have Facebook or Amazon and Apple and NVIDIA and Google. They were the FANG stocks. They've all been walloped. I mean, and I mean, Tesla would have lost 69% of its value in the past year. I mean, so it's So but my point is that people had say $50,000 in cash value on their policy last year. Now they have like $58,000. So what's wrong with that?
So I just want to touch on one more thing, because, like I said, you've touched on this in your book as well. Again, we talk about banks and how they own a tremendous amount of life insurance. And again, just the last ones I looked at was, of Tier 1 capital, their safe, secure capital. I think Bank of America has about $25 billion.
Yeah.
That's B, right, with a B. Wells Fargo, which I, just throw on the coals anytime I can get a chance
fraud.
Because I think Wells fraud. Thank you very much. I've never heard of that. Yeah, Wells fraud.
Just got find another $3 billion the other week. Yeah.
Right. So they got close to $20 billion of whole life on the books, but they never tell you that that's what you should do with your money. And how deceitful, how awful is that that's what they're doing, but they refuse to tell you that that's what would be a good avenue for you to do. Again, is it all your money? No, it doesn't have to be, but they have 25% of their Tier 1 capital sits there, or 20%.
Yeah, it's not as much weight because after all the printing of money since the financial
right
is diluted, caused tremendous inflation, but it's still one of the biggest assets. They own more cash surrender value in life insurance and annuities than they do in the real estate in premises and computers, for instance. In other words, if you a typical bank, okay, you have to look at each one of them because each one's different, slightly different. But most of these banks have more money invested in life insurance than they do in their fixed assets, and that meaning major fixed assets for banks would be real estate, premises, and computer systems, that type of thing. So so they have more money invested in life insurance than they do in that stuff. Couldn't make this stuff up, but
And it's not only banks, right? So let's talk about just real quick. Right? So we have corporations that do this like crazy, nonprofits. The amount of nonprofits that own properly structured life insurance is crazy as well. But they're not reported. I mean, it's just nobody talks about it because it's not part of the salary for a nonprofit, right? They use it as a deferred comp, so it doesn't look like they're paying huge salary.
Exactly, and it's more difficult, because they don't have to file the filings, but like the banks do with the FDIC or SEC filings. So yeah, but they do. Yeah, they all do it. And actually, as you know, the specialists who just work in the nonprofit space for hospitals and so forth, who buy tremendous amounts of life insurance.
Yeah, I mean, we've worked with a number of nonprofits, and it's funny. It's just once they see and understand this, these small nonprofits, right? It could be nonprofits with 5 employees. They're like, we can do that. We can put a ton of money in these properly structured life insurance as a deferred compensation or just an asset. And again, if they're nonprofit, then you can dump a ton of money into them, and they don't have to worry about taxes. And it's great for nonprofits, and corporations are doing it as well. It's the same thing as the banks, right? So they put it there not for the death benefit so much, but as a place to hold and secure capital.
Yeah, and let's also look at really this, the I don't know how many life claims you've had, Wade, but I've had like 63 over my career, and it really it's as being good stewards of people's wealth. It's really one of the best things anyone can have when they graduate and people pass. And there's no question about it, as you know. So it's an economic workhorse. It's boring, but it works, and I like things that work.
If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast reach and help more people by ranking higher in searches and ultimately help more people get out of financial bondage. And don't be afraid to share this podcast with your friends and family, as we can be easily found on Apple Podcasts and Spotify.